Ever find yourself thinking about how to make your money work harder? Like really generate some income?
Yeah.
And maybe you're even thinking about a specific amount, like $200.
Yeah.
What could you do with that?
It's a good question. It's a question a lot of people have, you know? How do you take a limited amount and turn it into something more?
Well, that's exactly what we're going to be looking at today.
Okay.
We found this interesting article from the Motley Fool. It's titled, Got $200 to Invest. 2 elite, ultra-high-yield dividend stocks to buy for income and never look back.
Wow, never look back. That's pretty bold.
Yeah, it is. It definitely caught my eye.
Yeah.
So in this deep dive, we're going to really break down these two companies. We want to figure out what makes them tick, what their strengths are, and why the Motley Fool thinks they're such solid long-term income generators.
Let's go.
And of course, we're going to try to do this without getting bogged down in a bunch of financial jargon.
Yeah, cut through the noise.
Exactly.
Yeah.
So think of us as your guides through this article. We're going to try to make it all clear and understandable, especially if you're thinking about investing like $200 or something around there.
Okay, let's do it.
All right. The article was published on March 29th, 2025. So pretty recent.
Okay.
So the first company they talk about is Enterprise Products Partners. Their ticker symbol on the New York Stock Exchange is EPD.
Enterprise Products Partners.
Okay.
Yeah, I've heard of them. They're a big player in the energy world.
Right. As of the article, their market cap was something like $74 billion.
Yeah, that's a lot of billions.
Yeah. And on March 28th, 2025, just to give you a snapshot, their price dipped a little. It was down 15 cents to $34.10 a share.
Okay. But what about their dividend yield? That's what we're really interested in, right?
Right. That's where things get interesting.
Yeah.
Their dividend yield is a whopping 6.3%.
6.3%. That's a pretty significant yield. So for every $100 you invest, you're looking at about $6.30 in passive income annually.
And here's the even better part.
Yeah.
It's not just a one-time high payout. Enterprise Products Partners has increased their distribution to shareholders for, get this, 26 years straight.
26 years. Wow. That's incredible, especially in the energy sector, which can be pretty volatile.
Yeah, it really makes them stand out as a leader in dividend growth.
For sure. For sure. So what's their secret? What makes them so stable?
Well, their business model is pretty interesting. They operate what's called critical energy, midstream infrastructure.
Midstream infrastructure.
Yeah, it's basically the essential network for the energy industry. Think pipelines, processing plants, storage terminals, export facilities, that kind of thing.
So they're not actually producing the oil and gas, they're moving it around.
Exactly, and that means they're somewhat insulated from the ups and downs of commodity prices.
Right, so even when oil prices drop, their business isn't necessarily hit as hard.
Exactly. They're more focused on the volume of energy flowing through their systems.
Makes sense.
And another thing that contributes to their stability is the kind of contracts they have.
Oh, yeah. Tell me about those.
Many of them are long-term fee-based agreements. Some are even regulated by the government.
So very predictable revenue streams.
Right. It really ensures a consistent and reliable flow of earnings.
That's key for a dividend stock. I mean, you want to know that they can actually pay those dividends.
Absolutely. And speaking of paying dividends, the article mentions that they're currently generating cash flow that's 1.7 times greater than what they're paying out in dividends.
So that's a pretty healthy margin.
Right. They call it a significant safety margin.
Yeah. It means their dividend payments are well supported by their earnings, so there's less risk of them having to cut the dividend.
Right. And it also suggests that they have some room to potentially increase the dividend in the future.
That's what we like to hear. Okay, so what about growth? What's on the horizon for them?
Well, they've got about $7.6 billion in major projects under construction.
$7.6 billion.
Wow.
That's a serious investment in their future.
Yeah, these are all expected to start generating revenue over the next few years and really boost their cash flow.
So they're not just resting on their laurels, they're actively investing in their future.
Exactly. And they've got some really interesting projects in the pipeline, including a carbon dioxide transportation network.
Carbon dioxide. That's interesting. I wonder what that's all about.
Yeah, it's a partnership with Occidental Petroleum. It seems like they're looking ahead to the future of energy and seeing potential in carbon capture and storage.
A smart move. They're not ignoring the bigger trends in energy.
Right. They're adapting and evolving.
Makes sense.
And on top of all that, they also have a good track record with acquisitions. They recently bought Pinion Midstream for $950 million.
Pinion Midstream.
Okay.
And that's expected to add to their cash flow.
Right. The article says it should increase their cash flow per share in 2025 and contribute to their long-term growth.
So they're growing organically through new projects and also through strategic acquisitions.
Exactly. And all of this is backed up by what they call an elite balance sheet. They have the highest credit rating in the midstream sector.
That's a big deal. Having a strong balance sheet gives them a lot of flexibility.
Right. It means they can borrow money at lower rates, and they can make acquisitions without putting too much strain on their finances.
Yeah. That's really important for a company that's looking to grow.
Now, there is one important tax consideration to keep in mind. Enterprise Products Partners is structured as a master limited partnership, or MLP.
Okay, MLPs can be a bit different from regular corporations tax-wise.
Right. Instead of issuing a 1099 DIV form, they issue a Schedule K-1.
The K-1? Yeah, that can be a little more complex to deal with come tax time. You might want to talk to a tax advisor about it.
Yeah, good point. All right, let's move on to the second company that the Motley Fool highlights.
Okay, what's next?
It's NNN REIT. Their ticker symbol is NNN on the New York Stock Exchange.
NNN REIT. Oh, yeah, they're a real estate investment trust, right?
That's right. They focus on single-tenant retail properties.
Interesting, okay.
So on that same day, March 28th, 2025, NNN REIT's stock price was down slightly. Yeah. It closed at $42.06 a share.
And their dividend yield?
5.5%.
5.5%. Not bad. Not bad at all.
No, it's still significantly higher than the S&P 500 average.
Right. So for every $100 you invest, you're getting $5.50 in annual income.
And get this. They've increased their dividend for 35 consecutive years.
35 years. Wow. That's even longer than Enterprise Products Partners.
Yeah, they're in a really elite group of companies with that kind of track record.
That says a lot about their stability and their commitment to shareholders.
Right, so their business model is pretty specialized. They invest in single-tenant retail properties that are leased out under what are called net lease agreements.
Net lease agreements, what are those?
Basically, it means that the tenant is responsible for most of the property's operating expenses.
Oh, so things like property taxes, insurance maintenance, all that stuff.
Exactly. NN REIT just collects the rent.
So that's a pretty predictable stream of income for them.
Right. It makes their earnings very stable, which is great for dividend payments.
For sure. And they're not being overly aggressive with their dividend payouts either, right?
Yeah. No. They have a fairly conservative payout ratio. They distribute less than 70% of the core funds from operations as dividends.
Okay. So that means they're holding back some cash to reinvest in the business or to deal with any unexpected expenses.
Exactly. It's a sign of financial prudence.
Yeah, I like that. It suggests they're thinking long-term.
They are. The article says they expect to have about $200 million in free cash flow in 2025.
Wow, $200 million. That's a nice chunk of change to reinvest.
Right. They can use it to acquire new properties or to improve their existing ones.
Sounds like they're in a good position for growth.
Yeah. They also have a very conservative balance sheet, which gives them a lot of flexibility.
We've seen that with Enterprise Products Partners, too. It seems like a common theme among these stable dividend payers.
It does. And like Enterprise, they're not afraid to make strategic acquisitions.
Interesting. So how do they go about finding these acquisitions?
Well, a big part of their strategy is building strong partnerships with retailers. They do a lot of sale-leaseback transactions.
Sale-leasebacks. So they buy a property from a retailer and then lease it back to them.
Exactly. The retailer gets an infusion of cash, and NNN REIT gets a property with a reliable tenant.
Makes sense. It's a win-win.
Yeah. And it gives them a steady pipeline of new investment opportunities. The article says that over 70% of their investment volume since 2007 has come from these existing relationships.
Wow. So they're not just out there chasing every deal that comes along. They're being very strategic.
Right. It's a much more predictable way to grow.
For sure. Okay. So we've got Enterprise Products Partners with a 6.3% dividend yield and NN REIT with a 5.5% dividend yield. Both of those are way higher than the S&P 500 average of 1.3%.
Yeah.
Pretty impressive, right? Yeah, very impressive. So to recap, Enterprise provides stability through its midstream energy infrastructure. Yep. They have long-term contracts, and they're growing through new projects and acquisitions.
And they have that really strong balance sheet.
Right, super important. And NNN REIT is focused on net leased retail properties. They have a conservative payout ratio, and they're also growing through acquisitions and partnerships.
And they've got that incredibly long track record of increasing their dividend.
Yeah, 35 years in a row. That's really something.
It is. So the key takeaway here is that both of these companies generate stable cash flows. They're financially conservative, and they have solid growth prospects.
And that's why they've been able to consistently increase their dividends for so many years.
The Motley Fool article describes these as worry-free stocks for income investors.
Worry-free? I mean, no investment is completely without risk, of course.
Right. But these companies do seem to be pretty reliable when it comes to generating income.
Yeah, their track records and their business models definitely suggest that.
So let's go back to the beginning. With about $200, could you buy shares in either of these companies?
Well, based on the share prices from the article, it seems like you could. Enterprise was around $34 a share, and NNN REIT was around 42.
Right, so you could definitely get a few shares of either one,
Mm-hmm.
or you could split your money between them.
Yeah, the article didn't really talk about that specifically, but it's definitely an option.
Yeah, it all depends on your personal preferences and your investment strategy.
Right.
All right, so to wrap things up, we've looked at why the Motley Fool thinks Enterprise Products Partners and NNN REIT are such great picks for income investors.
We've explored their business models, their financial strength, and their impressive dividend histories.
And we've seen that they're both very stable companies with good growth potential.
If you're looking for reliable income, these two companies are definitely worth considering.
So as you're thinking about all this, consider what it really means to invest in companies that have such a long history of rewarding shareholders with increasing dividends. What other factors, beyond just the yield and the track record, might be important for your own investment decisions? What's going to help you build the financial future you want?
Questions, lots to think about.
Yeah, that's it for this deep dive. Thanks for joining us.
Thanks, everyone.
We'll see you next time.
See you later.